Hey everyone, welcome back to the channel. Today, we're diving into a head-to-head comparison of two powerhouses in the green hydrogen industry, Plug Power and Nel. These companies are shaping the future of clean energy, but they approach the hydrogen market in very different ways. In this video, we'll break down their business models, financials, orders, capacity, partnerships, and take a look at which one might hit profitability first. This video is for informational purposes only and is not investment advice. Always do your own research and consult a financial advisor before making any investment decisions. All right, let's jump in. Let's kick things off with their business models because this is where Plug Power and Nel really differ. Plug Power, based in the US, is building a comprehensive hydrogen ecosystem. They're involved in every part of the hydrogen value chain, producing green hydrogen through their own electrolyzers, manufacturing fuel cell systems for things like forklifts and stationary power, and even selling electrolyzers to other companies. They're also developing hydrogen refueling infrastructure to support their customers, like major logistics players. In short, Plug Power is aiming to be a one-stop shop for hydrogen solutions, powering everything from warehouse operations to energy systems for companies like Amazon and Walmart. Nel, based in Norway, is more focused. They specialize in electrolyzer technology, designing and manufacturing equipment that produces green hydrogen from water using renewable energy. NEL focuses on alkaline and proton exchange membrane electrolyzers, supplying them to industries, energy companies, and transportation sectors. Importantly, Nel spun off its hydrogen fueling station business into a separate company, Cavendish Hydrogen, in 2024, so they no longer directly provide refueling stations. Instead, Nel's core mission is to deliver the equipment that powers hydrogen production for clients. While Plug Power is building an entire hydrogen ecosystem, Nel is the go-to specialist for the production side. Now let's talk numbers and check out their margins. Spoiler alert, neither company is profitable yet, which is pretty standard in the fast-growing hydrogen sector. We're using the latest Q1 2025 data for this comparison. Plug Power reported a gross margin of -55% in Q1 2025, meaning they're losing money on every dollar of revenue. Their net loss was a hefty $196 million on $133.7 million in revenue, giving them a net margin of about -147%. That's a lot of red ink, but it reflects their massive investment in scaling up production and infrastructure. Growing a full hydrogen ecosystem doesn't come cheap. Nel isn't in the black either, but their margins are a bit less painful. In Q1 2025, their EBITDA was negative at $11 million, with a net loss of $17 million on $15 million in revenue. That translates to a net margin of -115.5%. Not great, but Nel's losses are smaller relative to their revenue, suggesting they're managing costs a bit better, even with a smaller scale. Cash is king in a capital-intensive industry like hydrogen, so let's see how their financial positions stack up. Plug Power had $295 million in cash and short-term investments in Q1 2025, with total cash, including restricted cash, at little over $1 billion. That restricted cash isn't immediately available, so their usable funds are tighter than the headline number suggests. With a net loss of nearly $200 million in one quarter, Plug Power's cash burn is significant, and they'll need to keep revenue growing or raise more funds to sustain their ambitions. Nel reported $196.36 million in cash in Q1 2025. That's less than Plug Power's usable cash, but their net loss of $17 million means they're burning cash much more slowly. Relative to their size, Nel's cash position is stronger, giving them a longer runway to operate without immediate pressure to raise more capital. Let's move on to orders, which show us how much demand these companies are seeing. Plug Power has landed major contracts with logistics giants like Amazon and Walmart, who use their fuel cells for warehouse forklifts and other applications. While they haven't reported an exact order backlog for Q1 2025, we know their customers are demanding 55 tons of hydrogen per day, compared to their current production capacity of 40 tons per day. That gap shows strong demand, but Plug Power needs to scale up to meet it. Nel reported an order backlog of $139 million in Q1 2025, which is impressive for their size. Nel's focus on electrolyzers means their orders are tied to the growing demand for green hydrogen production, a market that's picking up steam. Both companies have solid pipelines, but Nel's clear backlog figure gives us a better sense of their demand. Capacity is where we see if these companies can deliver on their promises. Plug Power is ramping up its hydrogen production, with facilities like their Georgia plant producing 15 tons of hydrogen per day. They're also building new plants and operate a gigafactory in Rochester, New York for PEM electrolyzer stacks with multi-gigawatt capacity. Their focus on the full hydrogen value chain means they're investing in both production and fuel cell manufacturing to meet customer needs. Nel is pushing hard on electrolyzer production. Their Herøya facility in Norway has a 1 gigawatt annual capacity with plans to reach 2 gigawatts by April 2024. In the U.S., Nel is expanding its PEM electrolyzer manufacturing facility in Wallingford, Connecticut, to reach 500 megawatts of annual capacity by 2025. They're also exploring a potential gigafactory in the U.S., with up to 4 gigawatts of capacity split between PEM and alkaline electrolyzers. These investments show Nel's commitment to scaling up to meet global demand for green hydrogen production. Both companies are expanding fast, but Nel's clear capacity targets and U.S. investments give them strong momentum. Partnerships can make or break a company in this industry, so let's check out who's backing these two. Plug Power has some serious heavyweights in their corner, like Amazon, Walmart, and Energy Vault. These partnerships give them access to massive logistics and retail markets, which is huge for scaling their fuel cell and hydrogen solutions. When your tech is powering Amazon's warehouses, you're doing something right. Nel has its own impressive lineup. They've partnered with Yara International for green ammonia, Hyundai for fuel cell vehicles, and recently signed a strategic deal with Samsung E&A, which could open doors to global projects. Nel also works with General Motors on hydrogen-related initiatives. Both companies have strong partners, but Nel's recent Samsung deal gives them a fresh boost in the international market. Now for the big question, which company might reach profitability first? Neither Plug Power nor Nel is profitable yet, and the hydrogen industry is known for its long road to profits. Let's break it down with Q1 2025 data. Plug Power's revenue was $133.7 million, but their net loss was $196 million, giving them a minus 147% net margin. Their cash burn is high, and while their larger scale could help reduce costs over time, analysts have pushed their profitability timeline to 2026 or later, with past projections often delayed. Their heavy investment in a full hydrogen ecosystem could lead to big wins, but it's costly now. Nel's revenue was $15 million, with a net loss of $17 million resulting in a minus 115.5% net margin. Their losses are much smaller, and their $196 million in cash gives them a longer runway. Nel's focus on electrolyzers taps into the growing demand for green hydrogen production, and their losses have been shrinking over time. Partnerships like Samsung E&A could help them land bigger contracts. Based on the numbers, Nel seems to have a slight edge in reaching profitability sooner. Their smaller losses, stronger relative cash position, and focus on the high-demand electrolyzer market give them a more manageable path forward. Plug Power's broader approach could pay off long-term, but their high cash burn makes the near-term more challenging. So, does Nel or Plug Power come out on top? It's a close call, and it depends on what you're looking at. Plug Power's market cap is $982 million with a price-to-sales ratio of 1.56, making it look more affordable than Nel's $389 million market cap and 2.83 PS ratio. If you're focused on scale and market reach, Plug Power's end-to-end hydrogen ecosystem and partnerships with giants like Amazon give them a strong position. But Nel has its strengths too. Their smaller losses, solid cash position relative to their size, and recent partnerships like Samsung E&A make them a focused player in hydrogen production technology. Their expertise in electrolyzers positions them well for the global push toward green hydrogen. If you're looking at who might hit profitability first, Nell's numbers suggest they could have a head start. Both companies are shaping the future of hydrogen in their own way. Plug Power is building a full hydrogen empire, while Nell is laser-focused on powering hydrogen production. There's no clear winner. It's about their unique strategies and how they navigate this exciting industry. And that's our deep dive into Plug Power versus Nell. The hydrogen sector is one of the most exciting spaces in clean energy, and both of these companies are pushing the boundaries. What do you think? Does Plug Power's all-in approach give them the edge, or is Nell's focused strategy the way to go? Drop your thoughts in the comments, and let's keep the conversation going. If you enjoyed this breakdown, hit that like button, subscribe, and ring the bell for more clean energy insights. Thanks for watching, and I'll see you in the next one.